Welcome, dear traders! The International Monetary Fund on Tuesday cut its global growth projections for 2022 and 2023. The fund set about a 0.8 and 0.2 percentage point drop, respectively, from its forecast published in January. And this is why central banks need to be more cautious when making monetary policy decisions. It's now risky to raise rates above neutral levels. Let's discuss the highlights of the Asian session. The Fed sticks to a hawkish stance on its fight against soaring inflation. It raised the key rate by 25 basis points in March. After that, the regulator signaled more rate hikes. The main question is whether the Fed will hike the rate by 50 basis points at once. Currently, the watchdog can easily do it. To some extent, it has no other choice. The annual inflation in the United States has already jumped to a 4-decade high of 8.5% in March. At the same time, the economy is fairly strong now. It means that it will not be hurt by monetary policy tightening. Meanwhile, the earnings season is in a full swing. Companies report their first quarter profit of 2022, so 49 corporations that are included in the S&P 500 index have already revealed their quarterly reports with almost 80%, beating bottom-line expectations. For comparison, about 66% of earnings reports usually show upbeat results. Positive quarterly reports as well as the dovish comments of some Fed members fueled investors' optimism. Yesterday, the main stock indexes edged higher, showing the biggest intraday gains for the entire month. The US dollar also went up amid expectations of positive macroeconomic reports. The Fed's hawkish approach continues to push the greenback higher. A rally in the bond market is a bullish factor as well. The 30-year government bond yield exceeded 3% for the first time since April 2019. The rate on 10-year Treasury inflation-protected securities also rose for the first time since March 2020. As a result, the US dollar index soared to the highs of March 2020 versus its six major rivals. On Tuesday, it approached a high of 101.03, firmly holding above 101.00. At the time of preparing material for this video, the index was trading at 100.61. At today's Asian session, it retreated slightly, moving in the range of 100.64 and 101.04. However, despite a slight pullback, the greenback is far stronger than other currencies amid expectations of rate increases in May and in June. While the US dollar index has been rising for 4 consecutive trading sessions, the yen plummeted to a 20-year low on Wednesday. It also lost momentum versus other quote currencies. Its weakness is partly associated with the Bank of Japan's decision to keep the yield of government bonds close to zero. To protect its national currency, the regulator on Wednesday offered to buy an unlimited amount of Japanese government bonds. However, a stronger yen may undermine a fragile economic recovery. The main problem the central bank is facing now is the trade deficit. Following a sharp decline to export to China and rising energy prices, import prices in Japan advanced significantly. In a March, the negative 8-month trend continued. Japan recorded a trade deficit more than 4 times wider than predicted, so it reached 112.4 billion yen, eclipsing the 100.8 billion yen estimated in the poll. Meanwhile, the ultra-soft monetary policies seemed to pay off. The dollar-yen pair declined to 130 yesterday, hitting a 20-year low. Moreover, the US dollar is sure to take advantage of the yen's rapid drop amid the increasing rate gap. However, today, in the Asian session, after a fall during 13 consecutive sessions, the yen was able to climb against the US dollar. The pair is consolidating between the resistance level of 129.40 and the support level of 128.04. At the time of preparing material for this video, the pair has already reached 128.56. Perhaps the yen resumed a downward movement following the comments of the Japanese finance minister. Shinichi Suzuki said that the damage to the economy from a weakening currency at present is greater than the benefits from it. As widely expected, at its monthly meeting, the Reserve Bank of Australia held the official cash rate at 0.1%. The regulator outlined the need to hike the key rate, but it postponed the increase because of the upcoming federal elections scheduled for May 21. It appears that the Reserve Bank of Australia's first rate hike in more than a decade may occur at the June meeting. As analysts point out, the Reserve Bank of Australia is drifting towards a hike. The AUD USD pair is trading with bullish bias. It's moving in the daily range of 0.7375 and 0.7433. The pair has already risen to 0.7424. And that's all for now. Keep close tabs on the latest market events with the InstaForex TV channel. Thanks for watching and do not miss our next video review. See you!